What's up, everybody? Welcome to another edition of the Free Toaster News Pod. I'm your host, Carlos Caro. Today, we're going to do something a little different. Nick is out of the office. He's on a trip with his family. And rather than cover the news in the newsletter, I spent the time writing a short editorial piece. It's called "The Future of Distribution and Lending Seems Obvious." You may have already seen it if you're on our email list for the newsletter. If you're not on the email list, you can check it out at thefreetoaster.com and just sign up. We send an email once a week, usually on Wednesdays or Thursdays. This week it went out yesterday. I'm recording on Friday, so Thursday you should have seen that. And I'll get into that. That'll be the focus of today's conversation. Before we get to that, I want to thank our sponsor for this week at Bulldog Media Group. They're actually going to be at the summit that we're hosting on September 23rd. Darren, who's the CEO, will be there, and there may be other folks from the Bulldog Media Group team out there. They're particularly good fits for personal loan providers and credit card companies that have products in kind of the near prime, subprime, not perfect credit type spaces. Really worth a chat. They've been very successful for decades in that audience. And on the topic of the summit, for those of you that don't know about it, it'll be on September 23rd in San Francisco, hosted at a venue called the Exploratorium. You can find more information about the event at events.thefreetoaster.com, but I'm super happy with the audience that we're curating there. I just posted it recently on LinkedIn, but we have, I think it's 42 or 43% of the audience is either C-level or at kind of the executive senior level of either the publisher or the lending side. So we're getting a really good group of folks. There's, I believe, 88 tickets that are spoken for, and our capacity at the venue is right around 150. So we have 62 seats left, I think, by my math. If this is something you're interested in, still a great time to register. All right. So let's get into this week's story. Title of the piece, what I was trying to do this week is put together themes I had written about over the last several weeks and really consolidate them down into no kidding, what's going to happen here with AI and LLMs, and are consumers going to materially change how they shop for financial products? And if you've been following my stuff, I think you'll know my take is the answer is yes, that things will be changing. But the focus on the piece today is how long will we have to wait for that future? That was kind of the question I was attempting to tackle this week, but I want to do a little bit of setup here so that you can kind of follow the thinking. So first, we'll start with where the world is going. So if you've been paying attention to what's happening in technology, I think the future of digital information and products that rely on that digital information, it's seeming pretty obvious to me. So you're going to hold up your phone or your smartwatch or whatever the fanciest gadget is that the big tech companies are selling, and you'll utter a request in a sentence or two, and then what you want will just happen. I think unlike the first wave of internet and mobile, where it still required meaningful human intervention, this era is going to be defined by how effortless and fast things are going to get. So I always find travel to be a really interesting example and kind of corollary to think about lending transactions. It's nuanced, it's personalized, there's a lot of dimensionality to airline tickets, and in particular is what I'm thinking. So instead of spending hours on Kayak to find and book the perfect flight, I think the way this is going to go is your AI assistant's going to know your preferences, your constraints, your hotel. It might even be plugged into your Google Calendar and your meetings. It'll know your frequent flyer numbers, your credit cards, your budget, all of it. And instead of making you do all the hard cognitive work of deciding, it'll just act. So you'll fire up and ask, I need to go to New York for a business trip on Tuesday. I need to be home by 10 p.m. I don't want to leave until after 9 a.m. Make it happen. Ticket confirmations are going to magically appear in your inbox. And what used to sometimes take hours and some real thinking is going to take minutes, maybe even seconds, and no thinking at all. So what will this look like in consumer finance? So in the 2010 to call it the era we're in now, all the way up to 2026, refinancing your credit card debt required, I'm going to use talking past tense. That might be a little weird, but it required real work. So first you had to calculate how much debt you needed to refinance. Then you had to do the math to figure out how much money you stood to save if you refinance. So after all, you have to do this cost benefit analysis to even understand if it's worth pursuing at all. Then you had to go shop around to see which banks had offers for you and had good rates for you. And you had to do this carefully because if you generated hard inquiries, that meant lowering your credit score and then reducing your odds of a successful transaction in kind of the following inquiries. And then you had to compare all the terms and the rates. The lowest rates come with shorter terms. The longer terms come with higher rates and lower monthly payments. So there's a bunch of puts and takes in this decision. And then crunching all the numbers to understand the total cost of credit. And then whether or not your cash flow could handle the monthly payments. That was also some real work. And then you had to conduct a transaction after all of that. So that meant filling out forms online, sometimes talking to humans, tracking down forms like W-2s or pay stubs, sending the documents back sometimes to the bank to confirm your identity, and so on. And then to make this more complicated, this all presumes you know what you're doing. And if you didn't know what you're doing, you're going to have to spend some time online or talking to friends that are familiar with this process. So we're a huge step forward from where the industry was pre-internet, but we can do much better. And then I'm calling what our fairly obvious future looks like. It's going to be something like this. Hey, Claude, this summer I spent too much time on my summer vacation. It's sitting in my card right now at 29% APR. I think it's about $4,000, but I'm not totally sure. I want to pay off that card in full and pay it off in $100 monthly payments until it's gone. So Claude's thinking for a little bit, a few seconds. Hey there, friend. I found some great options for you. Number one is a personal loan with Chase, your primary bank. That APR is 9.25%. The monthly payment's $100, just like you asked for. It'll take 48 months to pay off. It'll cost you $800 in total interest over the 4 years. Also, we found a personal loan from SoFi, a popular digital lender. That APR is 7%. The monthly payment's $124, and it's going to take 36 months to pay off. That'll cost you $464 in total interest over the 3 years. P.S. That balance you talked about from that summer trip, it's on your Chase Amazon card. It's actually $3,850. I suggest going with a 4K loan. Most banks like the round numbers and putting that extra $150 in your checking account. So what are we going to go with? Human takes some time to decide. Let's keep everything consolidated with Chase. Option one. Done. I'll handle this. You'll see confirmation emails from the banks in 10 minutes or less. If I need any extra info or approvals, I'll text you. So that's how this is going to go down. I don't think... and by the way, this future state is toned down, admittedly. So the real future of consumer finance is the AIs, the LLMs, the machines know your goals, your constraints, your preferences, and they're doing whatever it takes behind the scenes to make that happen. Some consumers are going to want to be informed about every transaction and money movement that their self-money, I think what will be called self-driving money, is doing. And some won't care. They're just going to want the result. So anyways, that's where I think we're heading. If you think the future looks dramatically different in consumer lending, I'd love to chat about that, maybe even have you on the pod, but that's kind of where I'm seeing things going. And so then the question is, when will we see this future in lending? Let's first start with the fact that we know consumers are adopting LLMs at unprecedented growth rates. I'm staring at a chart here. It's on a Substack that I found. But essentially, it's weekly active users. Looks like it's by month, starting at early 2024 all the way through 2026. And we have ChatGPT reaching almost 100 million, so 1,000 million, so 1 billion weekly active users. And just 2 years ago, it looks like at around 120 million. So it was like close to 10x, it's look like. This chart's in the newsletter if you want to go see the data yourself. So clearly the adoption's incredibly fast, much faster than we've seen for other types of technology. So then the question is, when will the default shopping experience for lending products change? Clearly search has changed. Clearly the way people interact with Google is changing. But we have to overcome two blockers. Okay, we're going to lay out each of these two blockers. Number one lenders are afraid of what the machine will say. So I don't think this is something the big lenders are broadcasting all that openly. If you're inside one of these large lenders, I'm guessing you've already heard about this or hear this quite often in internal dialogue. But I hear this from friends in the industry, folks I speak with that work at lending organizations. Basically, if an LLM describes a product and gets a term wrong, whether it's the APR, the fee, the intro period, we could have a UDAP issue. And that's unfair, deceptive acts and practices. The CFPB said in 2023, so this is a little dated, that a chatbot giving a consumer wrong information about a fee or rate can constitute a UDAP violation. So you have to put yourself in a complier leader's seat. Let's say the marketing team walked in asking to provide a bunch of information to feed into Claude or ChatGPT, or a model that's inherently probabilistic is going to paraphrase it in a way you can't preview, at a scale you can't always audit, to a consumer you can't identify. I don't know many or any compliance professionals that are going to say, yep, sounds good, let's ship that. There's a phrase in the industry that I've heard from friends. One of my business partners likes to say it more often. And the quote is, no one at a bank has ever gotten fired for saying no. I don't know the origins of that quote exactly, so I just put it as anonymous in the newsletter. I think that's a reality. There's going to be a lean towards saying no. A lot of people could get fired for being an early mover in something like this, or in an industry that operates cautiously towards change. Blocker number 2, consumers don't yet trust Claude and ChatGPT with their financial data. So I haven't studied this in depth. I haven't done panels or surveys or anything like that. So I can talk about myself. This is kind of just conjecture. I'll just call myself Exhibit A. And I think the LLMs do a terrific job of finding consumer lending products for us once we trust them enough to hand over our credit profiles and bank accounts. And then we'll have to hand over our consent to conduct transactions on our behalf. I haven't done that yet. I'm not particularly close to getting comfortable, by the way. And I'm in it. I think about AI and how it's changing the industry every week, sometimes every day. I'm as bullish on this future as anyone you'll meet, but I haven't given an LLM the access to a financial account, even something as small as a credit card. So I draw the line at giving it summarized data for my accounts. So I strip out my PII, I strip out account numbers, I strip out anything that could be kind of associated exactly with one of my accounts. And I'm happy to feed it information just so it has context to help me with something I'm doing. But my trust stops there. I suspect consumers today are willing to share that type of context. I also suspect they're extremely nervous about sharing credentials because you just never know what these LLMs are going to do with your account. Not that we think they're malicious, but once the information's out there and then something happens, it would suck to get your bank account drained by an AI. So I think that's something I worry about. I suspect it's something others worry about. But here's the thing about these blockers. They support each other and they keep each other in place. So the lenders aren't going to do what's required to make the LLMs an effective acquisition channel until they see the consumer demand for that. And then the consumers aren't going to feed the LLMs the data, the consents that are required to transact until they see a killer app from the bank. So it feels a little bit chicken and egg. Seems like neither side wants to move first. I go back and I think about what I'm calling the mobile banking deja vu. So I was in the early 2010s. I was at a large Fortune 500 bank. Mobile banking was on the rise. It was kind of cool. People were talking about it, but people were a little nervous about it too. We were asking ourselves questions like, will consumers really bank on their phones? Will they really check their transactions here? What will security look like? Do we need to bring all the features from the desktop here or just really basic stuff like paying your bill? These are ridiculous conversations in retrospect, but I remember being in consensus meeting after meeting about this sort of thing. So let's take a look at what the Federal Reserve's surveys had to say about this. Per their research, only 22% of mobile phone users with bank accounts used mobile banking in 2010. So 22%. That was the adoption rate. And it took until 2015 to reach 43%. So we have to go back and think about the iPhone launched in 2007, and it took until 2015, so 8 years, for 43% of consumers to bank on their phones. It's a pretty long time. I remember how excited people were about the iPhone when it launched. To now go back and think less than half of people were banking on their phone 8 years later. I suspect that percentage is in, the high 90s now. I don't know for sure. Maybe I'll go look at that and amend the newsletter so you have the data point. I suspect it's very, very high, but we have to kind of calibrate that back to when ChatGPT launched. So that launched at the end of 2022. So that same 8-year timeline puts us at the end of 2030 before banking through an LLM or an AI will become mainstream, and mainstream at kind of the half the people use it, half don't. That feels about right to me. So like, now what? Most of the lenders I speak with are still sourcing new customers through the same channels they were using 5 to 10 years ago. So we're talking about direct mail, affiliate channels like Credit Karma and Experian, paid search, paid social, and first party channels. Now be channels like like branches for banks. But when we read the headlines, AOver's taking over the world. Little has changed in this particular industry for acquiring customers into lending products. It looks very similar to what it did 10 years ago. That was right around the time when I joined Credit Karma. It doesn't look all that different. So I hear about affiliate marketplaces toying with AI, but the changes appear to be early. They feel experimental. As a CMO at a credit card or a loan company, I wouldn't expect dramatic changes to distribution in the next 12 months. I would expect SEO and paid search to continue to get harder as that traffic moves away from Google and into the Claudes and the ChatGPTs. I'd expect affiliates to continue to think about how they're going to work with the LLMs and continue that experimentation. I think direct mail and social marketing, that's going to hum along. So the three things I'd start doing as a CMO right now would be, one, to make sure my organization has a good compliance framework for how we'd handle LLMs talking about our products. I think that's a really rich, meaty conversation that's going to take some time. 2, I'd make sure my account opening technology makes it easy for the LLMs like ChatGPT and Claude and all the bots and agents to transact with me. I mean, the theme here is I think the buyer's transitioning away from humans towards bots and agents. And that's a technology problem that needs to be solved. So that's easy and frictionless for that new class of buyers. And then I think this probably maybe the most important one. I'd be sure to invest and double down in my brand. I think ad presentation rates, conversion rates, and LLMs like Claude and ChatGPT, they're going to be 10 times higher or more when the customer mentions you by name. Way different thing to say, hey, I need a credit card, and hope that the LLM raises your card as part of that answer, versus if the customer says, you know what, I trust the Capital One card. I like them. What Capital One products are available to me? That's a very different ballgame if you can get that kind of named brand recognition in these prompts and in these requests. So I think most CMOs are going to look at this list and feel like it's a really unurgent thing to do. I also think suddenly something's going to happen. We may be a few years out from this moment where something will change suddenly that will make all these things feel really urgent. Particularly number 3, the investing in the brand. That one takes a lot of time. So I'd start that one now, no matter what, no matter your outlook. But the no regrets move would be to start on all of them now. I just really can't imagine a world where you won't have to knock them out eventually. That's where we'll wrap today. If you have a strong point of view on anything I just shared, whether in agreement or disagreement, would love to hear from you. You can contact me here at carlos@thefreetoaster.com. Or if you're a newsletter subscriber and you received this piece, just hit reply to the email. Nick and I read all the responses. So thanks for tuning in today. And I think we'll be back in our normal news groove with Nick and I next Friday. We're very likely to cover NerdWallet's earnings report. They released yesterday. I haven't dug into it yet, but they did see year-over-year growth. Their stock popped around 10% today, last I checked. Actually, let me pull up my ticker. I've been watching. Okay, it's up 11% now. So investors seem to react positively to what they had to say. Nick and I are going to be digging into that, unpacking it. Likely covering it in the newsletter to some degree, and also talking about it here on the news pod. So that's a wrap for today. If you'd like to support the show, the most important thing you can do is share this pod or the newsletter with a friend or a colleague. That'll help us keep growing. So thanks for tuning in today, and we'll see you next week.